Hey, 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 welcome back, everyone. Welcome to another weekly show live with Caeli. Today is June 14th, 2022, and we pulled Caeli out of the grave. She's still got one foot in. She's still recovering from the battle with having a illness. It's affected the markets in such a crazy way. Rates continue to fluctuate until we get Caeli back here full time. Then I'm sure they'll all calm down just fine. As always, these events are brought to you by Ridge Lending Group. If you have any questions at all, if you ever need any insight, education, mortgages, we do a lot of real estate investing, mortgages. So feel free to call 855-74-RIDGE or email at info@ridgelendinggroup.com. And we have her at the beginning here on camera, which is a beautiful thing. Caeli Ridge, welcome back, and we're glad you're doing better.
Thank you, Larry. I appreciate the introduction. Hey, you guys. It's good to be with you. I missed you guys. I've been out of commission for a while for a variety of reasons, traveling 1 week. And then as Larry alluded to, you probably heard my COVID number was pulled. You know, it's funny because I was getting a little cocky about the fact that we're 2.5 years into this thing almost, and I hadn't gotten it. And just as soon as I started to really feel the full effect of that, boom, the universe said, nope, just kidding. We don't have too many people on camera. I was just going to see if anybody wants to raise their hand. Who's had this thing? Everybody on this call, I would suspect. And if not, I think that really everybody I'm talking to is saying that it's a matter of time, right? It's like getting a cold, but I'm feeling some fatigue stuff. So I've been asking around and seeing who else has been suffering from that and how long. Anyway, I'm glad to be here, glad to be back. We're going to talk about interest rates today. You guys probably got the little teaser email from this morning, kind of giving you an overview, what's been going on in the markets. I'm going to talk just briefly. Larry's going to interject, and then we'll just do some Q&A like we usually do. I want to start by saying, as interest rates go, the first thing I want you guys to remember, really, really important, is please try to take the emotion out of it. I think that as consumers, especially in mortgage and investors, interest rate comes with a certain psychology that people tend to over emotionalize before they really look at the math. And that's going to really be kind of the spirit of this conversation about interest rates. So it needs to be looked at from an investment perspective, and hard crunched numbers is what we want to be paying attention to, not the sky is falling, because it certainly isn't. I would also comment that we're right on the precipice, you guys, of being in another cycle, real estate cycle. And if for anybody that's been around long enough, has seen a few of these real estate cycles, this investment is very cyclical. You know that they come, in waves. Usually I would say maybe 10, 12 years. We're due for another one. And the good news for us is that we're going to be, we've been really on a seller's market high. I think that for us investors that are on a buyer's side, it's going to be a unique opportunity for us to take advantage of the coming, months, I would say this year in particular, through summer and certainly into fall. And as far as interest rates go, I'll get into what my prediction is for later in the year. But it's time to get ready, right? To be taking advantage of the different markets where affordability, because rates are going up, is not going to be as available a thing for most homeowners. That means more inventory for us, supply and demand, and we should be able to take advantage of some of that as buyers. So let's talk about rates and that emotional piece to it. I think that, and I don't know, Larry, if it was attached to the email that went out, I recently penned a Now You Know article related to interest rates. And in there, I commented that most people that I talk to are often surprised to learn the true difference in monthly payment. Here's the math between a 0.5 point in rate. Depending on the loan size, that's a big criteria here. Depending on the loan size, if we're talking about $100,000 to $300,000, $400,000, it's going to be on the low end of what that payment difference is. Now, as the loan size starts to go higher, $500,000, $1 million, et cetera, a 0.5 point can be a much more substantial difference. But in general terms, most of us are purchasing, residential properties, single family residence up to 2 and 4 units, in that $1 to $400,000 range. So a half a percentage point in rate might only mean $20 a month, $50 a month. Is that the difference between the property making sense for the long-term buy and hold? I would suspect that most of us on this call today are buy and hold investors, or at least that's a part of our portfolio or our strategy. That buy and hold is part of what we're looking at. The fix and flippers really shouldn't be worried about rate at all. So let's just look at it from that mathematical perspective. If you know what the taxes are, what the projected rents are going to be, what the insurance is, if there's HOA, you have enough information to figure out what your proposed PITI is. Just as a reminder for anybody new, principal, interest, taxes, and insurance against what the rents are going to be today. And then you can figure out, how much am I losing because rates are now at 6.5 or 7%? What does that mean for my investment right now? And then make sure you take it the step further and the step beyond that and the step beyond that. And that means looking at annual appreciation, not the home price appreciation, that comes in a minute, but the appreciation of rents. If you're not appreciating your rents annually right now by a modest 3%, something is wrong. I need to talk to you. You need to talk to your property manager. Most of you have heard me say this before. As we continue to see interest rates rise, what happens to our rents? They're going to go with it. They will catch up. The unfortunate piece for that comment is that they don't go at the exact same time. They don't move at the same speed, but they will catch up. So whatever your factor is today, whatever your cash flow is today, is going to be less than it was yesterday and last week and last month and certainly last year. But it will start to gain ground. It'll start to catch up with itself. Then we have to layer in home appreciation. Now, while I think that affordability for the homeowner is going to start to constrict, that's going to give more inventory available to us, that supply and demand. The appreciation that we've been seeing so far is not sustainable. This is a good thing, you guys. So while home prices are going to cool off a little bit, we're still going to be in an appreciating market. A lot of people like to go back and point to 08, 09 and what was going on there, and then the appreciation rates that we were seeing at unprecedented levels. That is a very, very different time and place in history, not to be repeated. I firmly believe that what we experienced, for those of you that were around and lived through that, we will not see that again. Housing prices will cool off, but they're not going to fall through the bottom. That's not going to happen for a variety of reasons. And we can get into that if anybody wants to talk about it, but let me keep on track here and keep with my theme. So appreciating the rents, then we're going to appreciate the property will still continue to climb and go up in terms of your investment when you're looking at it from a holistic perspective. And then the tax benefit too, that's piece 3. You've got your depreciation, you've got your other expenses that you can be claiming, depending on whether you fall in as a real estate professional exemption, right, within the IRS code, really will dictate how aggressive you can be with the tax deduction and what you're able to save from a taxable implication. But all of those things really need to be considered. And I think that the investors that might be a little bit newer or green, or maybe some people that just operate more from the side of fear, are really going to be paralyzed by the headlines and the idea that interest rates going up means real estate is not a good investment. I'd be interested if anybody is willing to put this in the chat. How many people are invested in the stock market as well as real estate?
So for anyone who's looking for the chat, it should be located at the bottom of the Zoom meeting. And it should be a spot for chat. Go ahead and put it in there.
I'm seeing a few people raise hands. So right over the last 72 hours in particular, maybe 4 or 5 days, I would assume most of you have felt the sting of what your stocks have been doing. Bitcoin, similarly, you guys know what's going on out there. You're seeing the headlines. So from an investment perspective, I will always be bullish on real estate, despite the interest rate. You have to do the numbers. Don't just take that headline and rates are out of control, or rates are going to be back where they were in the 80s. I'm not sure I agree with that, but despite any of it, do the math, right? run the numbers. We'll help you with that and see what it means for the investment. And then we will start to layer in all the other components. If you're even cash flow positive $50 a month right now, you have somebody else making a mortgage payment on a piece of real estate that is an investment for you on a long-term buy and hold. Most of our investors are not getting into real estate today using their passive income, that net cash flow every month, to make their ordinary expenses every month, right? They're not using it for that purpose right now. They're buying investments right now. They're stockpiling cash flow for what's going to come next. More often than not, I'd say 9.9 times out of 10, people getting into real estate investing on a residential side right now are not taking the monthly cash flow and using it to pay all of their expenses. This is a longer burn, team. Okay, I'm just talking to hear myself talk again. Let's go through some questions. Larry, anything you want to add to that?
No, I think, thanks, Caeli. And I think it's important, again, for context, right? So one of the things that that email stresses that's going out this Friday to everybody, it stresses the context of interest rate relative to your position. So for the benefit, Caeli and I were kind of having a laugh before the call started. One of the loans that we help with is a debt service coverage ratio loan, where the property just kind of qualifies for the loan by itself. And, that's the first time I've actually set an interest rate in the 8s. And I kind of paused, like, when was the last time you heard any interest rate in the 8s? And it was probably, for me at least, it was probably in the late 90s. That was before the first big refi boom when rates were in the 6s. It's kind of one of those things. So I think for everybody, Caeli, I think it's important to really maybe do the math, some examples just because you gave one in the email. Where it's like, at $150,000, which is an average loan for Ridge, what is 1 point? It sounds huge. What does 1 point really mean in that monthly payment?
Yeah. I failed to address too, from a qualifying perspective. So those of you that understand the mechanics of this and how the interest rates are going to drive the return, plus or minus, gain, loss, whatever, for qualifying purposes, I think there's a disconnect as well that some people assume, and this is for investors, we're not talking about homeowners right now, that some people assume that when these interest rates are on the rise, that maybe they can't qualify anymore for this new mortgage, when in fact, chances are extremely high that, yeah, you can qualify. I'll quickly go into the underwriting guideline of purchasing an investment property and the debt to income ratio of that. When you're purchasing a rental, as long as you don't live rent-free and have zero history of being an investor, we're going to be able to, at minimum, offset the new mortgage payment with up to 75% of the rent that will be found on the appraisal. Okay, the property does not have to be leased when you're purchasing a property. Fannie and Freddie will allow us to use the appraisal, of which on an investment property comes with additional forms, one of which is called a 1007. It's just the number on the page. We call it a 1007. These are the rental income comps. These are like-kind properties that the appraiser has selected, 3 or 4 of them maybe, that are similar bedroom, bathroom within the vicinity that are tenant occupied. This is public record. So the appraiser is going to take the gross rents of these comps, these rental income comps, he's going to add them together and divide by the number of comps that he chose. That number is what we're going to give up to 75% of to offset the new mortgage payment on this investment property you're trying to purchase. Again, depending on how much experience you have as an investor and if you have a primary housing expense, the only exception to being able to get or not being able to get any income whatsoever on a new purchase of an investment property is if you live rent-free and you have no experience as an investor. If you have one or the other, a primary housing expense or a year or 12 months worth of experience, we're at minimum going to be able to offset the new mortgage payment with whatever the gross rents on the appraisal say. I can promise each of you here today that there are no circumstances, even if rates go to 8%, that's going to dissuade or disallow your qualifications from a debt to income ratio perspective in a rising rate environment. It just won't. So I wouldn't worry about rates as a function of qualifying. So just to kind of layer that in there, that would be another point of discussion for this topic.
There's a couple questions, Caeli. You
Yeah,
want to take one?
sure,
So,
sure.
Axel made a great question, really, more than a comment. Is interest only loans, which I haven't actually seen come through yet, but are interest onlys perhaps a good idea to help offset the interest rate rising?
Yes, Axel. Hello, my friend. He and I actually had a conversation about this maybe a couple of weeks, month ago. I like an interest-only loan. I always have. Unfortunately, we have not seen the tides turn yet where it's mainstream again. Interest-only used to be very prevalent, as did ARMs, adjustable rate mortgages. Post 0809, those product kind of lines went away. Some of you have heard me talk about inverted yields. I probably won't get into that, but just to say that I do believe that both interest only, let me back up. Interest only is available, but the adjustment to get the interest only part of the scenario increases the rate so much that it defeats the purpose. It doesn't work out giving you the benefit of the intended interest only. So while yes, they're out there, like I said, it makes it so that the rate is so much higher because of the interest only component that the cash flow doesn't improve. Okay, that's about to change. Adjustable rate mortgages and interest only options that make it more viable, that will give you that extra cash flow, are on the horizon. I hesitate to give you a date for this, but in the next 30 to 60, maybe 90 days, you could expect to see some of those options available. But again, run the numbers, do the math. How many times have you guys heard me say the math won't lie? It will not lie. It'll tell you what your return is going to look like based on the variables that we can solve for, that we know. We know what the projected rents are going to be. We know what the taxes should be, the insurance, all of those things. If you have that data, you're going to be able to very easily see how it's going to pencil, whether it's going to be just a straight principal and interest 30-year fixed, an adjustable rate mortgage, interest only. Does anybody want to talk about adjustable rate mortgages from a historical perspective? Is anybody interested in that? Because I'm actually a big fan of adjustables. I'll just go for it.
You got a yes from
okay.
At least Gloria.
Okay. All right, Gloria, this is for you. So ARMs, adjustable rate mortgages. These I think got a bad rap, largely because of 0809. I know I keep going back to that, but prior to the crash, housing and lending industry simultaneously imploding on themselves and each other, ARMs were very streamlined. Everybody got an ARM. It was very commonplace for, especially for investors, because the interest rates back then were usually a full percentage point below a 30-year fixed, right? They could get better cash flow. It was still a 30-year amortization, right? The payment was still amortized over that 30-year period of time, but you were taking an interest rate and fixing it in for only, say, 5 years, after which it could adjust. Okay, no problem. We'll just go ahead and refinance after that time. And that was historically a very common tool used for many people, investors, but also owner-occupied as well. Here's why I like an adjustable rate mortgage in a market that provides that at least half to point better in rate. Historically speaking, you guys, a lot of people are surprised when I talk about this. The shelf life, the average shelf life of a 30-year fixed mortgage, which is really all we've had access to over the last 10, 12, 15 years, is on an owner-occupied, and we know that an owner-occupied has a longer shelf life than an investment property, generally before refinance or sale, is about 7 years right now. So if we assume that a non-owner occupied, the shelf life of that mortgage, that 30-year fixed mortgage, is 5 or 6 years, it just automatically starts to get you to think, well, maybe it makes sense. Maybe I should be looking at an adjustable rate mortgage if it's producing that lower rate where my cash flow can be better. The other thing that I tell people that they're often surprised about is that the percentage of people that start on day one with a 30-year fixed mortgage and make 360 payments later to pay that off is less than 1%. Okay, the number of people that secure a 30-year fixed mortgage today that are going to have that mortgage in 360 months from now is almost no one. All right, so keep that in mind too. As soon as we start to see that real change, that tangible change on real time, daily interest rates, and the ARMs are coming down, I've always been a great proponent of the adjustable rate mortgages, and we'll keep you guys informed, right? Once those products start to become more beneficial, you'll hear from us, and we can look at them, you know, the scenarios as it applies to your specific needs, your goals, and the property math, the numbers.
So I want to bring you back to a couple of things that were mentioned earlier, Caeli, to go right into math and numbers. So one of the questions came up, Sean, and I couldn't really help, so my apologies. But earlier you mentioned you thought that most investors weren't using their cash flow to budget for expenses. Can you speak more to that and what you meant and maybe what they're doing instead?
Yeah. So what I mean is that most investors, as they're starting, they're not using the cash flow, right? So if the rents are $1,000 a month and the mortgage payment is $750, all in, right? With the property management, everything. I'm not including vacancy or maintenance here, but let's just say there's a $250 spread there, okay? Most people are not taking that $250 and using it to pay their food or entertainment or credit card bills or car payments, right? That's typically not what they're doing with the cash flow of these properties. More often than not, they're stockpiling these monies and using them as reserves down the road to qualify. They're using them for more down payments, right, for their next acquisition. More often than not, those monies, at least as they start their, you know, phase one, even phase two of real estate investing, they're not being used to fund their lifestyle, whatever that means.
Gotcha. So you were talking, when you said expenses, you meant their personal expenses.
Yes.
Gotcha. All right, cool. Sean, thanks for that question. Hopefully that helps you out. Eddie had a more feedback and maybe you got some opinion on this, Caeli, but now that rates are changing and, you know, where he's saying is he still sees in his market, Eddie's market, he still sees deals that fall into the 1% rule for, I'm guessing you're talking about rents, Eddie?
Yeah.
But now you're worried, Eddie's worried about how higher rates and higher purchase prices are still on his mind in terms of how is that going to really fit into investing into the near and longer term future?
So first of all, hi, Eddie. How are you, my friend? First of all, it's going to be very market specific, you guys. If one market is doing really well, another may not be doing as well, right? Maybe the appreciation is just kicking in too fast, and the barrier to entry is too high to make the numbers work. So, and every market is going to be different, okay? If I'm understanding the question, as long as the mortgage is covered, as far as I'm concerned, or maybe just even the smallest amount negative, I still think that real estate as an investment, depending on your qualifications, your goals, and your portfolio as it exists today, I still think more often than not, it's a good investment. I need to see it. I really would like to see, Eddie, if you've got a scenario to run by, we can look at it together for me to give you my real opinion. But if you've got 1% in your market, meaning for anybody that's not clear on what that is, if the purchase price is $100,000, the rents are coming in at about $1,000, right? That's the 1% rule. If you've got the 1% in your market, even with the rise of interest rates, you should be just fine. Cash flow is going to go down a little bit, but not enough to avoid the investment altogether.
And so kind of wrapping that back, Caeli, into intermediate adjustable rate mortgages, as the technical people call them, are just ARMs, right? Where the interest rates are locked for 3, 5, 7, or even 10 years. Again, for those that have been in lending or have borrowed money for quite some time, you know, Alex put in the chat that he had a 7-1 ARM, kept it for longer than the 84 months the rate was locked, enjoyed the fall down, you know, the roller coaster down when the index fell, and it was still made sense to keep the ARM. You know, everybody initially called him crazy because, oh my God, why would you do an ARM? And now, of course, everybody's like, dude, that was the smartest thing ever. Like, how are you so smart?
And I'm going to give Axel the credit because that was probably by design, right, Axel, not default. What he was, so for anybody that doesn't totally clear of, let me just kind of, so Axel got a mortgage. It was a 7-year ARM, which means after 7 years, the interest rate's going to adjust. It's going to move up or down. Well, when he got his, it was probably, if I had to guess, what, Axel, 05, 06, 04, 03, something in that range. Well, when things changed, 05, okay, 2005, I see you. As it started to adjust in 2012, it adjusted down, right? And because 0809 was unprecedented, they, the powers that be did not have in the loan documents at the time what we call now floor rates. They didn't account for that provision, meaning that rates, there were some people on adjustable rate mortgages after the crash, the interest rate would have been almost a negative, right? So the interest rates went down. If they started at 5%, they were probably paying 2-3% in interest for years after the crash. Fast forward to today, loan documents that you're 2.5%. Geez, that's amazing. Fast forward to today, loan documents that you're going to be signing that have to do with adjustable rate mortgages will have caps, rate caps, life caps, floor rate. The floor rate is going to be a provision that says that no matter what happens with that index, if we ever saw something like we did back in post 0809 or just after that, no matter if the index goes super, super low, you're never going to pay less than X in interest on this mortgage. So there's a floor rate, right? That can't, the rate that you're going to pay interest on is never going to be below. There are caps associated with how the interest rate can adjust after the fixed rate period is over. And then there are life caps that say it can never go above this level. So the lowest, the highest, and then in between the caps of the interest rate, it can adjust to. Like usually it's 1% at a time, right? If you started at 5% after the fixed rate period and the adjustments start, each adjustment can't exceed 1% at a time, that kind of thing. So those are some of the mechanics of, or the inner workings of an adjustable rate mortgage.
And again, I hate to reminisce because you could just do that forever. But yeah, back in the day, it was one of those questions, right, Caeli, of how long do you really plan on keeping the property? Like, yeah. What's the deal? Why are you taking a 30-year fixed when it just doesn't financially and mathematically make any sense?
Yeah.
Are there any guideline differences, Caeli, that investors need to worry about when looking at ARMs?
Ooh, that's a good question. It's been so long since I've done ARMs. I would say that the one thing that you probably want to be prepared for, guidelines, qualification-wise, they're going to take, God, Larry, you may have to help me with this. I know that on the adjustable that we do have now, the all-in-one first lien HELOC, which happens to be interest only, by the way, for qualifying purposes, they're going to require that we take the fully indexed rate on a principal and interest basis. Larry, what was it? It was 2 points over the start rate.
So typically, right. So from a qualifying perspective, typically when you have a 3 and 5 year, you have to qualify 2 over start rate. And when you have a 7 and 10, you qualify at the actual note rate.
So what that means, for example, guys, if the start rate was 5% on a 3 or 5 year ARM, okay, we're going to qualify you based on 7% principal and interest, right? It wants to account within the movement of the loan and the rate. It wants to make sure that your ability to qualify if and when this thing starts to adjust up to 2 points over where you started. So they're going to be more conservative on the qualifying piece, which what we're saying here is going to dictate your debt to income ratio. If the interest rate you're locking in and starting at is 5%, but you have to qualify at 7%, that's to your benefit, right? Just to make sure that your debt to income ratio can support if it were to go to that place at that point in time.
I had a chance, Caeli, because when was the last time we actually looked on Fannie Mae's product matrix for the differences between a fixed rate mortgage and an adjustable rate mortgage? And I will post this out for those listening along now, as well as the recording on the community. I'll post the PDF and the link in case Fannie updates it. But there are small differences between the fixed rate mortgage and the adjustable rate mortgage in terms of LTV. Very, very small, but only at the highest loan to values. So as an example, for primary residence, you're limited to a 95% on an ARM versus you can go to 97% on a fixed.
Huh.
The rest of the LTVs are actually uniform all the way down for investment properties and second homes.
So from that perspective, gang, that just really means that the only difference for you, as it's going to apply to you in investment properties, is probably going to be that qualifying over what your fixed start rate would be. So DTI would come into play. If your DTI is below 45% today, chances are there's not going to be any issue. Yeah.
Okay. If anyone has any questions, feel free to use the chat, or you can take yourself off mute. We are going to probably end here shortly. So if you have any questions, now would be the time. So Eddie wants to know what is our take on the recession buzz that's all over the media. I'll just go first because Caeli can drop the mic on it. But there's no doubt that our economy at some point will stop growing. And in my opinion, that has to do with when people stop spending money, right? So you can't go into a recession if people are still spending money, regardless of what their rates are. What concerns me the most about when this is going to happen is how much people are willing to put on their credit cards. I don't know about you. I don't know about your household out there, but I can tell you, I use Mint to like track my expenses and everything. And I'm not seeing a change in my household behavior yet, but that's what I think everybody will, once people start realizing that they can no longer actually live the lifestyle they've been living because they can't afford to on their credit cards anymore. I think that's when our economy is going to turn. Caeli.
No, I wholeheartedly agree, and I think that people struggle to batten down the hatches when things start to get tight, and changing their lifestyle, as you said, Larry, is difficult for some people. But I think overall, I tend to agree that it's a foregone conclusion. Recession, I mean, I think that it's very, very likely, more likely than not, that that's going to happen. And when that does happen, we're going to see some reprieve on interest rates. I mean, just kind of keeping with the theme of this live event here, recession will probably be good for us. Overall, guys, real estate is where I'm putting the bulk of my money continually, and I've done well enough to continue to beat that drum for our clients and those that have any interest in diversifying and looking at real estate as a long-term investment.
I will say, I will ask you a question. This is coming from me, just because I don't think anybody else will think about this. But I've been watching a lot of people miss opportunities to cash out on their investment properties to get that money in as cheaply as possible, even if they don't necessarily have a property in mind today. I know historically, Caeli, you're not necessarily a fan of taking money and putting it in a savings account and losing interest because you're not doing anything with it. But with rates on the move, do you have a different opinion about that now?
That's actually a very, very good point, Larry. I'm glad you brought that up. I think it's going to be case by case. I would want to talk through it with anybody that's interested in doing this. I'll tell you right now, very, very likely, chances are whatever interest rate you have now, you would be replacing it with a higher interest rate. But to Larry's point, and going back to how I started this conversation, do the math. We are about to be in a situation where cash will be king and taking advantage of lower price points, a buyer's market from a very, very heavy seller's market. Having access to that cash, even if it means that you're paying interest on money that you're not using for a few months, may make sense in the market that you're looking to purchase in. So I think that very subjective to the individual and the market that they may be looking in, but don't discount refinancing and harvesting equity because it's at a higher rate than what you're paying now. As long as it cash flows, okay, and we know that we're going to be able to utilize that cash for what's coming. Having forethought, right, is something I think that eludes a lot of people, myself included. I've been part of that school where I wasn't ready for the next wave. So I think that's what you're referring to, Larry, right? Is having access to those funds as soon as possible, because you're right. I don't think rates are going down anytime soon. The longer you wait, the more expensive it's going to be. It still may make sense. I don't know. But knowing where you stand now is probably not a bad idea. Let's take a look, guys. Send us your stuff and we'll do the math. We're going to do the math for you, and you can make an educated decision based on real tangible numbers.
I'm always trying to look ahead of what's happening with the curve. And again, for those that have been doing this a while, we saw from 08, we saw loan products disappear. We saw line of credit canceled. We saw all kinds of crazy stuff happen that you would never have thought could happen. And like anything else, exactly when you don't want to ask for money is when you need it. You want to have it ahead of time.
That's true. That's so true, you guys. And I am, and I this is not to imply that Larry is going down this road. I'm not a doom and gloom. Okay, but being prepared and saying the sky is falling and you have to do whatever, those are two very different things. I got caught up in 0809. For those of you that missed some of my story or haven't heard me talk about it, there was some dark years right after 0809. We had a lot of properties. None of them had equity anymore, where the day before they had tons of equity. And I just didn't think that both of those things at the same time, having no equity anymore and then zero access to credit, I couldn't do anything. I was completely paralyzed. I had 42 properties and many of them were on ARMs, some of them 6-month ARMs, right? And then like that overnight, you couldn't have more than 4 finance properties. The availability of credit and what I had access to kind of move things around and refinance into this and that and make some changes was gone. I don't think that's going to happen. In fact, I know that's not going to happen. That's not where we're headed, okay, at all. But I think that the underlying point here is having options and the availability, run the numbers, see if refinancing for what might be coming in a month or 2 months or whatever, even if you're not going to be using it today, is not going to be a bad idea as long as the tenant is making your mortgage payment. Don't worry about the interest rate.
Great stuff. We've got time for one last question. Sean, we're going to close it out with you if you don't mind.
Great. Can you hear me okay?
You're sounding great.
Hi, Sean.
Thank you so much, Caeli, again. The DSCR loan, what does Ridge require again, so we can be ready to rock if we have an opportunity again? I still am bitter that I wasn't able to close the deal with you the other day because I didn't have my ducks in a row. What does Ridge require so that if I get another cash flowing property, we can just go for it together?
So you want to apply first. If you haven't received the link for our online application, just let us know. We'll have that sent out. Get your application in. Documentation wise, very simply, we need your assets, right? Where your down payment's going to be coming from. There is a reserve requirement that we need to show. Insurance, some ID, right? Your driver's license or something, evidence of insurance. The list is short, and I'm just going through in my mind and thinking.
Yeah, you've got, not to cut you off, but you've got my application.
Okay.
All ready to go. And what is the reserve requirement? I guess that's probably more direct to my question.
Yeah.
2 months or something?
Yeah, I want to say 6 to 12 months. It's going to depend on the investor that we're selling to.
Okay.
The more reserves you have, the better terms, right? Probably a slightly better interest rate than if you only have 3 months or 6 months of reserves. So I would say between 3 and 12 months, and depending on that and credit score and loan to value and loan size and the debt service ratio will ultimately dictate what the rate will be. Ideally, let's talk about the debt service really quickly. We like to see for the optimal rate 1.25 or greater in the debt service ratio. For those of you that don't understand what that means, it's so simple. You're going to take the gross rents and divide them by the proposed PITI. So let's just do one together really quick. Anybody that has their iPhone or their cell phone handy, I want you to put in $1,000. That's our gross rents. And I want you to divide that by $750, just for easy math. What you should see on your calculator there is 1.33. Optimal interest rate on debt service ratio wants to see 1.25 or greater. So that would be greater, right? We can go as low as 0.75 on the debt service ratio. It can still qualify at 0.75, but you're going to start taking some real hits to rate on anything below 1.0. 1.0 means that the rents and the PITI are the same. The rents are 1,000 and the PITI is 1,000. That's going to give you 1.0. So 1.0 and above is kind of that range you want to be in. 1.25 and beyond that is the best for interest rate. Sean, am I answering questions?
Yeah, definitely. I appreciate it. That was the main question. How much do I need to have where for how long? You know,
So,
I've got everything else. The debt service coverage ratio was, I think, 1.8 on this last deal. It was great.
cool.
But I just didn't have any. You looked at it, you loved it. I remember you said, "Oh, those are great numbers." But I didn't have enough cash somewhere. I think reserved.
Okay.
I didn't have
Let me
enough.
quantify really quickly. So we've got the reserve requirement, which is kind of what we show on paper that you have in addition to, and then you've got your down payment, right? You're 25% down, you're 25% down, and then closing costs, those monies that are going to be deployed for the transaction. Those need to be seasoned, sourced and seasoned for 60 days for most debt service ratios. For anybody that doesn't have, let's say that you need 100 grand to close, okay? If you don't have that, or we can't show that for 60 days, ping me individually and I'll check guidelines and see if we have any investors that will take less than 60 days seasoning. So what that means is that I've got bank statements, 2 months worth of bank statements that show your balance at $100,000. Large deposits will be questioned. And if I can't show they originated with you, then we wouldn't be able to use them. Let's say that you sold a car or liquidated some stock or pulled money from a HELOC. Those are sourced and seasoned funds. You got a bonus at work. Those are sourced and seasoned funds. If Great Aunt Irma said, Sean, here's 100 grand, go invest in real estate, I can't use that as sourced and seasoned. Those are gift funds or borrowed funds. They will not be allowed until they've sat in the account for 2 months, right? So I don't see the balance or the deposit anymore. I only see the balances. Now there may be investors that we sell to that have a less than 60-day source and seasoned, but I need to look it up. So anybody that has less than 60 days, ping me and I'll double check and let you know.
Thank you very much.
You bet. Anytime, sir.
Well, I first of all, thank you very much, Caeli, for coming out, and we certainly all hope you continue back to 110% like you like to go, because you can't go anything less than 110%. For everyone else, there's been a lot of great discussion today. The continuation of that discussion can happen if you have any questions on the community. Both Caeli and I monitor all posts and questions, etc., on the community. And like Caeli said, if you've ever got a personal situation, email over or call in. That's what we're here for, and we appreciate you paying attention to what we do. And so at the end of here, we want to thank again Ridge Lending Group for putting this all together. 855-74-RIDGE or info@ridgelendinggroup.com. We'll keep the information coming. Friday, we'll send out Caeli's latest penned article for Now You Know. And if there's anything we can do, topics or discussions or whatever, please let us know. We'll be glad to talk about it every Tuesday, 4:30 p.m. Eastern or 1:30 p.m. Pacific.
Thanks, gang.
Thanks, everybody. Have a great rest of your day. Bye-bye.